in listen-only mode.
Hello, welcome to the Not Your Mama's Bake Sale, Your Giving Can Change the World webinar. My name is Amanda Rufo, and I will be your technical producer and moderator this evening. This webinar will be presented by Kathy Weber. Our goal is to provide some new insight into the topic of giving and how our giving can make a difference. Before we start the presentation, let's take a moment to ensure that everyone is ready and familiar with the webinar control panel. On the right side of your screen, you will see the attendee control panel, and on the left is the webinar viewer window. This window will display the presenter's screen when the webinar begins. The control panel can be minimized or expanded by clicking on the horizontal double arrow button in the upper left corner. Minimizing the panel allows a better view of the presentation. Take a moment to practice. There are a few features of the control panel that the attendees should know. First, be familiar with the Raise Your Hand button. This button is located along the left side of the control panel. It allows you to virtually raise your hand if you have a question or if you want to respond to a question being asked by the presenter. Let's practice raising our hand with this question. Who is a Kappa? Raise your hand now. Clicking again will lower your hand. Nice job. Another important feature of the control panel is the questions pane. To submit a question, type it into the question box. These may be questions related to the presentation or technical questions related to the GoToWebinar system. You may also be asked by the presenter to type your ideas or responses here as a part of an exercise during the webinar. Please send a quick note to your questions pane now. Questions may be submitted at any time. These will be monitored and we will try to respond quickly if we see something that shouldn't wait until the Q&A period, such as making a clarification. During the webinar, you will be asked to respond to a polling question or survey. Please take the time to participate as your input and ideas are valuable to the group. If you need to step away for a moment, do not close the GoToWebinar window, as you will be required to log in again if you wish to rejoin the session. If you experience problems with the audio, one possible solution is to use the conference call number and listen to the presentation using your phone. Click the Use Telephone option in the audio pane of your control panel to view the conference call number. The webinar is being recorded, and the online archive will be available to view on the CAPA website in approximately 2 weeks. Are there any questions? Well, we have a few to get started with today. We wanted to get to know you a little bit more, so we're going to start with a couple of polls. So let's launch our first one. And it is, my age is, and then you have boxes to check there. Please take the poll now. Okay, and we're closing the poll. So for our results, Kathy, we have 20% that are under the age of 35. 40% are in two categories, both between the age. Cast your polls now. the Mississippi, and we would like to know about your giving experience. So we have categories. Okay, I'm going to be closing the poll. So we have 50% that give at bake sales, 75% that give at cash or check, and 25% that give to other. And now I'd like to hand the virtual microphone over to Kathy. Kathy?
Good evening, everybody. I'm happy to be with you for the next hour. I'll talk for about 30 to 40 minutes on some of the thoughts I want to share with you, and then we will have more time for discussion and question and answer. So our topic for tonight is Not Your Mama's Bake Sale, Your Giving Can Change the World, an insider's guide to best practices in philanthropy for 2012. So first of all, how I'm looking at this time together is that this should be educational and fun. I want to inspire and encourage you to take your next step with your own giving, whatever that might be. I am not a lawyer. I don't give legal advice, and I'm not a CPA. I don't give tax advice. So who am I? Well, I am a financial advisor, and I have worked at Morgan Stanley Smith Barney since 1982. I'm a certified financial planner. That is really a credential that's about putting it all together, trained on taxes, estate planning, risk, investment, and insurance. I'm a certified investment management analyst. That's a certification from the Wharton Business School, really about the art and science of portfolio construction. I also have an ADPA certification, which is accredited domestic partnership advisor, and that is training on the special planning needs of unmarried couples and same-sex couples. I have been offering personal philanthropic planning as part of my wealth management practice to my clients who live in more than 20 states and several countries. So this is who I am. I'm a Kappa from the Gamma Mu chapter, Oregon State University. I'm currently leading a wealth management team where I've worked for several decades. I work for private clients, that's couples and singles. I really have a passion for helping women take their next step and navigate change. That would be, change in life, change in the economy, change in the world, change in priorities. I live in Kirkland, Washington with my husband, my son, our dog. We raise chickens, we dance, we garden, we photograph, and we have 3 grown children. So that's a little bit about me. And now before we launch into the meat, I want to ask you one question about your personal giving. I want you to think about the last time you made a charitable contribution, and I've got a poll question for you.
Okay, so we have the poll up right now. Think about the last time you made a charitable contribution. What motivated you to give to this cause? Select one or more of the following, please. I am passionate about the work of this organization. I am personally involved with this organization. I think this organization needs money. Someone I know and respect asked me to give to this organization. Okay, we're going to be closing the poll right now. And let me share those results with you. So can you see those there, Kathy?
No, you can tell me.
That's okay. So for the first one, I'm passionate about my work. We have 40%. I am personally involved with this organization, 60%. We don't have anyone giving in regards to the organization needing any money. and someone I know and respect asked me to give, and that's 40%.
Okay. Very interesting. So I want to tell you that how you see and how you have acted in one of your most recent charitable contributions is you actually act like the majority of us act. Most of us do not give money to an organization because we think they need it and because it makes sense rationally to perhaps do so. Most of us actually do give to things that we are passionate about, things we care about, and oftentimes we are involved then with things we're passionate about and we care about. And the other main reason that people give to philanthropies and charities, the research tells us, is because somebody that we know has personally asked us to give. So we're just like everybody in America in the last poll about charitable giving. So let's talk now about what can you do with money, because really philanthropy is about something you do with money. So during your lifetime, there are really only 3 things that we can do with our money. We can spend it, we can invest it for later, or we can give it away. That's it. That's all we can do. And giving it away, of course, is philanthropy. At the end of our life, what can we do? There are only 3 things that can happen at the end of the line with the money that's left over. If there's money left over when our life is done, there are only 3 things that can happen with it. It can go to people we name and people we care about. It can go to the government in the form of taxes, or it can go to philanthropy. It can go to charities and causes we are passionate about. I mention this because a lot of philanthropic planning is in fact about wanting more of the money that we have left at the end of the line to go to the people we care about and the causes we care about. And we have control to some extent over where the money left at the end is going to go among these 3 if we plan. So we have control, more control, if we plan. So how do I see philanthropy? Our giving really is the intersection of several things. It's the intersection of several things that we can see. So one aspect is, what are the needs that we see? Because our philanthropy is about addressing unmet needs, whether it is the food bank because people are hungry, or whether it's an educational institution for additional faculty or buildings or services, whether it is the Kappa Kappa Gamma Foundation that's doing good work for women and alum. It's something that we see in the world that needs to be taken care of. That is one of the ingredients of our philanthropy. The second ingredient is our generosity. It is because we want to. We want to do something. We're inclined to help. We're inclined to share. That's another ingredient. Third ingredient is our tax system. What are the rules of the road in this country as far as taxes? And what I say is that we can be more informed and we can be more strategic and get more leverage from our philanthropic dollars if we understand just a little bit about our U.S. tax system. And then the fourth thing is the giving tools. And we'll talk a little bit about that today. What are the giving tools? What do I mean by that? So philanthropy is where these 4 things intersect. And that is obviously the multicolored, wonderful place to be. So how do we give? Well, we can give our time, we can give our talent, and we can give our resources. So right now, I'm going to focus my comments on how we give our resources, because we all know we can give our time and our talent. But how do we share our resources most effectively to address those things we're passionate about, those unmet needs? Well, some of the ways we can give, and all of these things I'm going to speak of will be aspects to how you choose to do your giving most beneficially and strategically for you. So we can give cash or other assets. We can give during our lifetime or at our death. We can give once, or we can give regularly. We can give on a schedule. We can give annually. We can give a present gift or a future gift, meaning we can give now and complete a gift, or we can give something that will be delivered at a future time. We can create an entity to give beyond our lifetime. We can create a charitable entity that will have a life expectancy that's longer than ours. And we can give resources in a way that we can include people we want to include as a partial beneficiary of some charitable gifts, or a shared beneficiary, or a split beneficiary. So let me say that again. We can have someone we care about be included in some charitable gifts. So what impacts our choices about how we're going to give? These are some of the things that influence how we're going to give. The amount of the anticipated gift, the preferred timing of the gift, your income tax bracket, your estate tax bracket, your expectations of changes in the tax laws. Do you think tax rates are going to go higher or lower? Do we know if tax rates will go higher or lower this year versus next year, this year versus last year? Also, what we call the structure, the titling, amount, and character of your assets now. The structure, that means, is what you want to consider giving part of a business that has other owners in it? Is it a piece of real estate? Is it something that's worth $1 million or $50,000 or $500? Is it something that's jointly owned with other people? These are some of the kinds of things that we would think about when we think about what's going to impact the choice of how to give. Also, do we desire to provide for a spouse or a domestic partner? Is it important that a charitable gift also provides something for another person? And lastly, another thing we consider is, what about the involvement of others? Is this giving something we want to share? Do we want to share it with our children, our spouse, our partner? Is it important to include others in this gift? So these are some of the ways that we give and some of the things that impacts how we give, best practices in my wealth management practice and my philanthropic consulting to clients. Now, I want to pause and ask a couple questions of you about our tax system, because you see I've referred here to income tax brackets and estate tax brackets. So I want to ask a couple of tax questions.
Okay, so we're launching our first question, and it says, I believe I have a good understanding of the difference between adjusted gross income and taxable income on my tax return. Please select one of the following, yes or no. Okay, great. I'm closing the poll. So our results are 80% say yes, with 20% saying no. Okay, our second question that we have is the definition of the term tax bracket. And we have two choices here. Total percent of my income I will pay in taxes, or total percentage tax I will pay on the next dollar I earn. Okay, I'm closing the poll. Thank you for your participation. And our results, 60% believe it's the total percent of income I will pay in my taxes, and 40% believe it's the total percentage tax I will pay on the next dollar I earn.
Okay. I want to talk just for a moment about taxes. We're not going to get into detail, but there's a couple of concepts about taxes that if you understand these tax basics, you will be able to be asking the right questions to understand how to use our tax system to make the most of your charitable and philanthropic goals. So first of all, I'm glad that most of you have a good understanding of the difference between adjusted gross income and taxable income. What I want to tell you is, for those of you who don't, your adjusted gross income is usually a bigger number, and it is usually near the bottom of the first page of your tax return. I encourage you to look up that number on your most recent tax return. And the number taxable income is after all of your write-offs and deductions. It's the number that actually determines your tax bracket, and it actually determines how much tax you're going to pay. So these are two terms, and I would advise you to be aware of what these numbers are for you. And then there are just different tax tables, of course, for what kind of tax filer you are, if you're married or head of household or single. So these two terms, adjusted gross income and taxable income, will be good for you to track and know for yourself. Now, interestingly enough, on the definition of tax bracket, the majority of the people who took the poll answered incorrectly. So I want to take a moment and define tax bracket for you, and I want to just give you an example. So in 2012, a single person, a single taxpayer with a taxable income, that's one of those two terms I said to go look up, a taxable income, $50,000 single taxpayer in 2012 would be in a 25% tax bracket. Now that does not mean that that taxpayer would be paying a 25% tax rate on all of their income, because in fact there are lower tax brackets, and everybody pays the same lower tax rate on the first bracket of their income, and then a higher tax rate on the next bracket of income, and then a higher rate on the next bracket of income. So in fact, the more accurate definition of tax bracket would be the total percent tax I will pay on the next dollar I earn. That total percent you're going to pay on the next dollar you earn is in fact your tax bracket amount. The total percent of income you will pay in taxes will be lower than your current tax bracket. Now, that's all I'm going to say on that for now. Let's just take a look at a couple tax basics. If these are new concepts to any of you, I encourage you to delve into this a little bit more. It'll be useful for literally all of your financial planning decisions. A couple of basic tax questions. I do think taxes in general in our country, they seem like they're too complex, and they seem to be very complicated. So I want to just distill a couple of very basic things here, a couple simple concepts. There are two kinds of taxes to consider for purposes of charitable giving. There is your income tax, and that's the tax you pay while you're alive. And there's the estate tax, and that's the tax that's paid on your remaining assets, your remaining net worth after you die. Now, why does this matter? Why am I talking about taxes for a minute? Well, it's possible that if I give a $1,000 charitable contribution and I'm in a 35% tax bracket, I might save $350 in taxes this year. And if I give a $100,000 charitable contribution this year, I would save $35,000 in income taxes if I'm in a 35% tax bracket. So, you know, if I'm going to make a $100,000 charitable contribution to something I'm passionate about, and I can save $35,000 in income tax, that would go to the IRS if it didn't go to my charity I'm passionate about. That's a pretty big number. It's also possible that if I give a $1,000 charitable contribution that I won't save anything on my income tax return. The answer to what you will save on your income taxes from making your philanthropic and charitable contributions is linked to your taxable income. So these two concepts here about income taxes and estate taxes, there's these two things we're going to want to be aware of. You're going to want to be aware of what your tax bracket is when you're looking at what's the best way to get the most for each dollar you're going to contribute. Okay, so now let's take one more little quick question poll on taxes, and this is going to be the last two questions I ask you about taxes.
All right, we're going to go ahead and launch second to our last poll. So we have this question, true or false. In 2012, income tax brackets are 0, 15%, 25%, 28%, 33%, and 35%. Okay, I'm going to be closing the poll. So 40% of you say true and 60% says false. Okay, and our final question that we have for you. For a death in 2012, the maximum federal estate tax bracket is 50%. True or false? Okay, I'm closing the poll. And our results are 83% with true and 17% with false.
Okay.
That's all I have for you, Kathy.
Okay, so let's talk about those couple questions. In 2012, the income tax brackets are, it's mostly true. That means it's false, right? It can't be so in 2012, 60% of you correctly said that was incorrect because the bottom income tax bracket is 10%, not 0. But this year, income tax brackets are 10%, 15%, 25, 28, 33, and 35. The maximum tax bracket is 35%. For a death in 2012, the maximum federal estate tax rate is 50%. True or false? 83% of you said true. Interestingly enough, 83% of you are incorrect because for a death in 2012, the maximum federal estate tax rate is 35%. Now, 35% is one of the lower maximum federal estate tax rates in recent history. There have been many years where the maximum federal estate tax rate is over 50%. But for a death in 2012, the current rules, the current laws say the maximum federal estate tax rate is 35%. So one of the things that I want you to know is the maximum, these income tax brackets and the federal estate tax rate bracket, these things change from time to time. This is one of the most consistent ways that Congress tinkers with our tax laws. So this is something you can't learn just once and then put it to bed. You actually have to kind of monitor changes in laws, news. Either you might do this from reading the news, you might do this with your CPA, your estate planning attorney, your wealth management team. These are things that actually matter to how you plan your biggest bang for your buck on your giving. So let me get a little bit more specific. If you are making a current gift to charity, that is a gift to charity now while you're alive, you can get an income tax deduction this year, provided you itemize. There are two limitations. They are based upon to whom you give and what do you give. Okay, so those are the big picture rules. Income tax deduction, provided that you itemize. Two limitations correlated to your adjusted gross income. So remember, that is the term from the first page of your tax return. And the limitations are related to whom do you give and what do you give. What about after you're gone? Gifts to charity after you've died. If there's a charitable bequest in your will or in your estate planning, there is a charitable deduction for your estate. A charitable gift does reduce the size of your estate that may be subject to estate tax. Now I'm talking here again about federal estate tax, and the current exclusions from federal estate tax this year, for a death this year, $5,120,000 per person. Okay? So if you're married, that means this year, if you both died, you could shelter up to $10,240,000 from federal estate taxes. Notice, next year, it's $1 million per person. So you can see that's a big change from 2012 to 2013. This is something that is being debated from time to time in Washington, D.C., but there's not, and there's some people are watching and listening to see if there will be any change in this policy between 2012 2013. I don't know if there will be or not. Also keep in mind there may be a state estate tax in some states as well. So you get a tax write-off either to your income tax return while you're alive or your estate tax return after you're gone, and you can then potentially, with those write-offs, save taxes that would otherwise be paid. So let's talk about some of the specific tools and techniques that are being used today to leverage your charitable giving. And I'm going to group these tools and techniques into three categories. I'm going to give you examples in all three categories, and I'm going to close with three examples of real people and what they've done and how they've used some of these tools and techniques. So first of all, the first category of tools and techniques will be an outright gift. The second category will be a gift that really benefits two people, or a person and a charity rather. We call that a split interest vehicle. And the third will be the category of a technique where an entity is going to live beyond your lifetime. Okay, so first of all, an outright gift. You can give cash. You can give tangible assets like a car, art, household goods. You can give real estate, farm, land. You can give securities. You can give, for example, a highly appreciated stock that you bought 15 years ago and it's gone way up. And if you sold it, there'd be a big tax. You could give an appreciated security and even keep that profit from having to pay tax on that by contributing it directly during your lifetime. You can also give outright through a beneficiary designation on an insurance policy or an IRA or a retirement plan. So you can make a charity receive a gift outright either now or at your death. So that is one category of giving. Now there's also a group of tools that are what we call split interest vehicles. There's two beneficiaries here. And in each of these situations, it's going to be, yourself or whoever you decide, like your partner or yourself plus the charity. And these split interest vehicles can provide income now to you or income later to you, or simply a place to live as long as you live. What are some of these techniques that include more than one beneficiary, i.e. yourself and the charity? Well, there is something called charitable gift annuities, pooled income funds, charitable remainder trusts, charitable lead trusts, and remainder interest in your residence. You can give your house to a charity at your death, but use it during your lifetime and get a charitable write-off while you're living there. Charitable gift annuities and pooled income funds are oftentimes created at large universities and institutions of that sort, where you can make a contribution to the university and get an income back on that charitable contribution. And charitable remainder trusts and charitable lead trusts are slightly more complicated to set up, and they are unique to you. They're not, they're unique to you. You have more control. They're a little more complex, but you are going to basically, in a charitable remainder trust or a charitable lead trust, you will be benefiting both yourself or your family member and the charity that you want to support. So these are all 5 of these ways to have a benefit to both the charity and another person. And the last category, give to a charitable entity that lives beyond you. So there are these 3 things I want to mention that are entities where your giving, your contribution could live on. There are what we call donor-advised funds, where you simply put money in at one time and then have it distributed over a number of years. You can actually contribute to a donor-advised fund one time and get a charitable write-off, or you can contribute multiple times and get a charitable write-off each year you put the money in. It stays invested, and you direct where it's going to go over the years. And if there's money in the donor-advised fund at the end of your life, you have also already instructed the fund where that money will go. A family foundation. This is a little bit more complicated than a donor-advised fund, but it's also more flexible. And a family foundation, you can put money in once or a number of times, and you must distribute a certain amount of that foundation money to directly to causes or people on an annual basis. And the third being a community foundation. A community foundation, for example, in Seattle, we have a community foundation that takes in contributions and distributes them for the benefit of the people who live in this region, as well as to the to the donors' requested philanthropies, as well as to the needs of the region at large. So these are some of the kinds of charitable entities that can live beyond your lifetime. So what are the things that you will want to consider when you are considering which tools and techniques you're going to use to get the most out of your giving dollars. So aside from the tax benefits available to you or your estate, there are other things to consider. So there's the cost to set up a vehicle, a charitable vehicle. There's the cost to maintain it. There is a question of, does it generate income? Do you want it to generate income for somebody other than the charity? Do you want to have control? Do you want the maximum control, or are you willing to give up control? How much control do you want? And then there's complexity. Certainly, writing a check or giving something one time is much simpler than setting up a charitable remainder trust. But on all of these tools and techniques, it might be that you get a lot more money to what you feel passionate about if you choose the tool that's really the best and the most ideal for your circumstances. So again, cost to maintain, cost to set up, does it generate income, how much control do you want, and how complex is this tool or technique? Okay, so now I want to give you a couple of examples, actually 3 examples from my own experience of 3 of these tools and how they were used by real people and how it went for them. So the first one I want to tell you about is someone I know, a client of mine. It happened to be a couple, and they created a charitable remainder trust. What they had was they had a variety of passions. They had quite a few passions, and they wanted to do something for a lot of them. And they wanted to be able to change the charities that they were passionate about over the course of time. They had some highly appreciated assets. So they had some assets that had gone up in value quite a bit, and had they simply sold them, they would have owed a lot of taxes. So they wanted to benefit a variety of charities. They had highly appreciated assets, and they wanted some supplemental retirement income for their lifetime. So they put money, the client, the donor, put assets into a charitable remainder trust. In this case, they're the trustees of the trust. And then they got a tax write-off or a charitable deduction the year they put the assets into the trust, and they get a payment stream or a retirement income stream for life. They chose a 6% income distribution for life out of the corpus of, or the principle of, the charitable remainder trust. And then what happens? Oh, and they got the tax write-off when they put the money in at the beginning. And what happens then is they got to update the charities that this money is going to go to someday, and anything that's left in this trust will go to this portfolio of charities, if you will, at the end of their lifetime. And they are absolutely delighted with how this is working out for them with retirement income, charitable write-off way back when with their appreciated securities, and know that they have a portfolio of organizations that are going to get any money that's left over at the end of their lifetime. So that's an example of a use of a charitable remainder trust. I want to tell you now about another client who used a donor-advised fund. So I have a client who is a woman with no children, and she was a school teacher her whole life, and she wanted to honor her father, and he was a man who grew up in a rural area and barely graduated from 8th grade, but went to a technical college and got a voc tech education, and went on to have a number of businesses that thrived and did very well. So she wanted to honor her father, and she wanted to do that by providing scholarships to students in this rural, low-income region where her father grew up. And she wanted students to be selected who were B and C students, and she knew it was a low-income area, and she wanted to give scholarships to students who went to the Voc Tech College and learned the trades. So what she did was she put assets into a donor-advised fund. She got a charitable write-off, and she directs an annual amount of money to be sent from her donor-advised fund to the foundation that serves this vocational technical college. And every year now, they are fully funding tuition, room, and board for 25 students who may very well not otherwise have had the means to pay for a Voc Tech education coming out of high school in this low-income rural area. So this woman is absolutely delighted because she gets to hear the reports about the scholarship recipients, and the balance of her estate will go into this donor-advised fund, and they have instructions about how they're to distribute the money over the several decades after her lifetime. So this is a good example of how a donor-advised fund worked. It's simple, not complicated. It's all set up with an entity that already exists. And private family foundation. So I wanted to give you an example of a private family foundation. And this is an example from my own life, actually. When my husband and I got married not too long ago, we had already raised our children. And so we knew we weren't going to have any children of our own. And we knew we wanted some way for our children to know each other and work together. So we put assets, we created, when we married, a private family foundation honoring our two families, and we put in appreciated securities. We will put assets in for several years in a row. We chose a low-cost administrator to administer the foundation, and all we're going to need to do is go online and direct the foundation of where to make the distributions. We did this because we wanted to involve our family, we wanted to involve our children, we wanted to have a shared activity, we wanted to share some of our family values with them, and we wanted it to be a way for them to come together in a shared project. So, and we then also will turn over the leadership of the foundation to them in the course of time or after we're gone. So that's an example of a private family foundation. So I think it's time for some Q&A. Hello? Are there any questions? I am not hearing any questions. In fact, I'm not hearing any sound. So what I would like to say is, if there are any things that you would like to address with me at a later date, or anything that you would like to ask of me personally, any way that you'd like to follow up on something you've heard, you are welcome to contact me directly.